Good morning, everyone. Thank you all for joining today's ATRAM Market Outlook. I am Santi Elizalde, a Business Development Officer at ATRAM. Over the past few weeks, global markets have reacted aggressively to possible economic disruptions due to the COVID-19 outbreak and containment measures. So I'm sure you all have questions about where we should go from here. Here with me today are a few people who can help answer those questions. I'd like to introduce our Chief Investment Officer, Mr. Philip Hagedorn, our Head of Fixed Income, Mr. Miguel Liboro, our Head of Equities, Mr. JulianTarrobago Jr., and our Head of Multi-Asset, Ms. Alessandra Araullo. The format for this morning's webinar is going to be, first off, an introduction by our Chief Investment Officer. And we'll move on to the outlook portion, starting with fixed income, then equities, and more, that you may ask questions throughout the discussion by clicking on the Q&A button on your screen. If you would like to ask a question anonymously, you may do so by choosing that option in the Q&A section. Rest assured, we will get to all the questions at the end of the discussion. Additionally, I'd like to let you know that this webinar will be recorded and that copies will be disseminated within the day, as well as posted on all our social media pages. Let's kick things off with our Chief Investment Officer, Mr. Philip Hagedorn, to give us a backdrop on today's situation.
Thank you, Santi, and good morning, everybody. I'd like to thank all of you, clients, partners, colleagues, and friends, for joining us on this call today. I must admit that this past week has been the most challenging week in my 30 years as an investment professional. What we are seeing around the world today is unprecedented. As Bill Gates said in his TED Talk on the threat of a pandemic, which I highly recommend, and it's available on YouTube, countries were not prepared. The response to the pandemic was slow, and many economies around the world have grinded to a halt in hopes of slowing down the spread of the virus. The damage to these economies has yet to be quantified, but markets, as usual, have moved ahead with expectations of massive slowdowns in the coming months. The truth is that these slowdowns folks are fearing are likely to happen. But what is not clear is the magnitude and duration of these slowdowns. In this type of crisis, there are issues we can control and issues that are out of our hands. Today, our asset class heads, Miguel Liboro for fixed income, Philippine fixed income, JulianTarrobago for Philippine equities, and Alessandra Araullo for multi-asset, will share with you their thoughts on markets and how we are navigating portfolios at this time. I must add that I'm very proud of our ATRAM team. This week, we implemented a full 100% work from home policy, and this, together with our business continuity protocols, have allowed us to maneuver during these difficult weeks. Our team has been provided with all the necessary tools and connectivity to continue working from home with minimum interruption. If markets are open, we will have access to them, and we are able to manage our portfolios appropriately. In Mr. Gates' video, there are silver linings, and with God's grace and the ingenuity and drive of the human spirit, this crisis will be over sooner rather than later. Stay home, be safe, and enjoy the weekend with your loved ones. Thank you once again for joining this call.
Okay, thank you for that, Phil. Let's now transition over to ATRAM's views on the market. Let me remind everyone once again to please continue asking your questions using the Q&A button on your screens. We will get to them at the end of the discussion. To begin, I'll pass it over to Miguel Liboro, who will discuss the situation surrounding the fixed income markets and ATRAM's strategy moving forward.
Thanks, Santi. Good morning, everybody. So thanks for joining us for this outlook. I guess Welcome to the new normal as brought by the coronavirus world. And the biggest case in point, I guess, is that we're having this online as opposed to seeing everybody face to face. Now, a lot has changed over the last couple of weeks. And before we kind of go into where we think things are headed, I think it's very useful to describe where we're just coming from. So at the beginning of the year, we actually had yields move up across the Philippine government securities yield curve. And this is really due to the fact that at that time, it looked like there were a lot more bearish factors or factors that would have yields to go in play. There was some supply risk, which meant that everybody had a feeling that the Bureau of Treasury was going to issue bonds in the first, or a jumbo bond in the first quarter, but we didn't know how much and when they were going to do it. And at that time, it feels like such a long time now. U.S.-Iran hostilities had escalated, driving oil prices significantly higher, back above the $60 per barrel level. Additionally, we had what we thought was the black swan event for the year in the form of the Taal volcano eruption, which we felt may potentially cause inflation to spike higher than expected. All of these caused yields to move up or trace significantly from where we had ended 2019 at the year's lows. But where are we today? Over the last month, the US Federal Reserve has already cut their own overnight policy rate by 150 basis points, all the way back down to zero. A breakdown of the OPEC cartel has begun a new oil price war, which now sees oil trading at closer to $20 than $60. And we're seeing asset class correlations break down globally as even safe haven markets such as US Treasuries and gold are not spared from the risk of sell everything sentiment seeming to permeate financial markets at the moment. So what about Philippine fixed income in the midst of all this? Well, as I mentioned, a lot can change in 2 weeks because up until the first week of March, Philippine fixed income was actually doing quite well. As an investment grade credit, we are considered a bit of a safe haven asset class. And we were behaving as such. With global risk assets being sold off, Philippine fixed income was reasonably and relatively defensive. Over the last 2 weeks, we've joined the rest of the riskier asset classes in this sell-off. But why do we think that this is temporary? Because all the upward pressures that we mentioned have been replaced by downward pressures. The coronavirus isn't going to go anywhere anytime soon. At best, we're able to contain it, but the economic damage, at least for the first part of the year, is already done. We're starting to see that a little bit, but we won't really start seeing it in earnest until we see the end of quarter numbers and definitely the second quarter numbers. What does this mean? It means a reversal of all the factors that caused yields to move up in the first place. Inflation was projected to be in the midpoint, 3%, of the BSP's 2 to 4% target range. We've since seen that inflation has been unable to break past that 3% midpoint, having come in at 2.9% initially in January, and then dropping to 2.6% in February. Given recent events, while there is the possibility that for March, there is a slight uptick, we feel that this will move lower throughout the balance of the year. Additionally, we feel that the BSP will be more aggressive with the response to this crisis. As of yesterday, the BSP cut an additional 50 basis points, taking their policy easing down to a total of 75 basis points for the year and the overnight policy rate to 3.25%. We feel that they have more room to ease, meaning more support to give markets, more liquidity to inject into the system, which we feel will be bond positive. Taken in conjunction with our expectations of lower inflation and the fact that it is unlikely that the government's infrastructure program will be accelerating anytime soon, and it's highly likely that we see a bit of a deceleration in this front. It also removes the risk of drastic addition of bond supply to the market. This is also bond positive because with less bonds to go around, it will cause the demand to increase on the existing bonds in the market. This is something that we don't expect to change anytime soon. If we move to the next slide, you'll see how we've positioned our portfolios given these views. Given our views that interest rates will continue to move lower for the balance of the year, we are positioned heavily on the longer belly of the curve, meaning the 7 to 10 year portion, as well as the 15 to 20 year portion of the curve. This is because these are among the more liquid portions of the yield curve and where we think we have the largest probability of gaining capital appreciation as our view plays out towards the end of the year, for the balance of the year. While Philippine fixed income is not immune from the recent risk-off sentiment that you've been seeing in the market, we do feel that it continues to offer a very strong risk-reward proposition. I'd be happy to take any questions later on at the end of the presentation.
Okay, thank you for your insights, Miguel. Once again, let me remind everyone to please continue asking your questions using the Q&A button on your screens. If you'd like to ask a question anonymously, you may do so by choosing that option in the Q&A section as well. We'll get to all of them at the end of the discussion. Moving on to the next phase of our webinar this morning, I'd like to pass the mic over to JulianTarrobago Jr., who will discuss where we stand with equities at this point in 2020 and what we aim to see in the near future.
Good morning, everyone. Hope everyone is healthy and keeping safe. As we all know, this global pandemic has resulted to not just a medical crisis spanning the globe, but also an emerging growth scare across economies around the world as well. So in the next slide, we can see, looking at markets and economies all over the world, that the global containment efforts actually dampen the outlook on global trade and economic growth. We believe that increased testing could fuel a surge in the documented cases of COVID-19 over the next 4 to 8 weeks. Locally, the enhanced quarantine in Luzon, or the lockdown, essentially a lockdown, implies the economy is actually grinding to a halt in the second quarter of 2020. And early simulations by our economists suggest that GDP growth will likely be downgraded and will probably grow around 4% from about 6+% in previous estimates. In terms of sectors, we believe that earnings downgrades in select sectors are inevitable, but will likely be most pronounced in the gaming or casino industry, the airline industry, followed by oil and mining. Power companies and telcos, on the other hand, provide relatively low earnings downgrade risk in the short term. Next slide. So what we're seeing right now in the markets is clearly, well, first of all, we're seeing 5 to 10%, actually 5 to 12% intraday swings in the Philippine stock market. And for me, that is not normal. That is not by any chance normal. And that is indicative of indiscriminate selling from our conversations with key market participants. Suggests that there has been and probably may continue to be some indiscriminate selling in the market, and by virtue of those sudden major swings in the market. And what if there's anything I've learned over 25 years of being in the financial markets, it's that every crisis is unique, and but also every crisis has commonalities, and one of those commonalities is panic and indiscriminate selling. What in hindsight, looking at data over the last 20 years or so, the lessons from those years of being in the market is that you want to look for periods. Well, first of all, it's don't be a hero and jump in indiscriminately, non-selectively, and just buy the market per se. It probably is wise to look for periods of peak panic and be selective in terms of the approach into investing in the market. So what right now, I guess, is a period of panic, and there is very little rationality in terms of how investors are behaving. Those are things we cannot control. The panic is something we cannot control. What we can control is our analysis of what is happening, analysis on the economy, and our initial analysis is that GDP growth will drop to around 4% initially, and that earnings growth will go from our original estimate of about 11% to our preliminary simulation of 4%. But based on recent news, for example, like SM Prime will be expanding the moratorium on rent, not just within Luzon, but nationwide, suggests that this plus 4% could actually be more conservatively estimated to be flat for 2020. So I guess what I'm saying is the GDP growth will fall from 6% to probably 4%, maybe even a bit lower. And earnings, based on our simulations, will fall from 11% to possibly 0 to 4%. And the biggest downgrade risks are in gaming, industrials, and oil and mining. In the slide, you'll see that the hardest hit industries will be those sectors, and then where the hits will be ranging from 17 to 24% based on 1 month of a lockdown, and then followed by significant downgrades as well, potentially in property and banks, and then relatively less earnings impact on telecommunications companies, power and utilities, and consumer staples. So most likely a scenario of earnings growth falling to 0 to 4% because of because we have more news with regard to the lockdown and its impact on the sectors and on the economy. Next slide, please. So, like I said, panic selling has hammered valuations down to 2009 crisis levels. If you recall, the worst financial crisis in financial market was in 2008, 2009, which was the global credit crunch, and we are at those levels already. Next slide, please. So, does it make sense? Well, like I said earlier, when the sentiment is bad, people are less sensical and probably will just act on feeling, and that's understandable. If we were to add some rationale to the market, of course, when sentiment, what I've learned is that after sentiment eases or starts recovering, people will start being rational again. So maybe let's take a look at where we are now versus where we were in 2009 when the Philippines dropped to these crisis levels. In 2009, S&P credit rating was double B negative. It's improved today to triple B positive. GDP per capita has improved to 7,900 US dollars from 5,300 in 2009. Government to GDP position of the Philippines has likewise improved to 42% from about 55% in 2009. Unemployment rate has dropped. And very importantly also, the GIR, or the gross international reserves of the Philippines, has actually doubled to about 87 billion, 88 billion, compared to 44 billion in 2009. So there's been significant improvements in the economy, is what I'm trying to say, compared to 2009. But we're at levels where we were in terms of earnings multiples compared to 2009. Next slide, please. So using we showed you the PE earlier, that the PE is down to single digit already, very low levels relatively for the market. But we also note the fact that the price earnings ratio, while very useful, also has some deficiencies. It does not take in, it has a lot of distortions in terms of non-recurring earnings being part of that, in terms of dilution earnings being part of that. What we revert to usually is during these periods of significant volatility is the Buffett ratio, which is the market cap to GDP ratio. And for the PSEI, if you look at the chart, PSEI market cap to GDP has fallen below 60%. Why is that significant? It's because the last time we've dropped below 60% in terms of market cap to GDP was during the period wherein we had the worst global financial crisis ever. So we're at those levels already. Yeah, does that make sense for people who believe that this will stretch out 1, 2, 3 years? Then yeah, maybe best stay out of the market if that's the case. We're a bit more optimistic in terms of the economic impact of this crisis over the long term, and that it makes some sense to be selectively buying during periods of the big swings, positioning essentially for 2021. Next slide, please. We're seeing corporate buybacks restarting, and the slide shows corporate buybacks for select companies that we thought were significant. Next slide, please. So at the end of the day, this crisis has caused the market to drop to worst global financial crisis levels, and we think while we may not have seen yet the peak panic level for the market, meaning near-term volatility will likely linger. It's really not a question of will the market recover at some point, but we think it's very important to point out it's really more a question of when will the PSEI recover. And with regard to where or when that bottom will be, some things worth noting. Peak panic or the market bottom potentially could be within the next, 4 to 8 weeks. And there are 4 key factors that people need to consider. First is when the COVID-19 daily infection rates in the US in particular and in the Philippines hit their peak, or when the daily infection rates start going down. That's one. Second is when global PMI, or the manufacturing index, hits trough or seems to be peaking and has already bottomed and is stabilizing or on the way up. And the third is when there is clear-cut fiscal easing that becomes more evident. And this is, I think, something we're seeing already right now. For those economies where there was an initial period of denial, I think there is an increasing resolve to address this issue from the powers that be. And of course, the fourth factor that will be monitored, that will be a plus, is if a vaccine is actually announced. There's been talks from different private and public groups that everyone's in a race to come up with a cure to this thing, but that's the last factor. But the first three alone, meaning inflection rates peak, global PMIs hit troughs, and if there's clear-cut fiscal easing, could indicate already peak panic and more rational in terms of how the market should move, or a rebound, I guess, after the markets have really declined by so much to crisis levels. We believe that the weak first half GDP and earnings growth is temporary, and not that our base case still points to a rebound in the second half, whether it's 3Q or 4Q. Our base case is that there will be a recovery in demand, continuation of accommodative monetary policy, and a resumption of infrastructure spending that will improve prospects for GDP growth, rebound, and corporate earnings growth rebound in the second half. We also like to note structural improvements in the economy from even before all of this started, there were already structural improvements that will be underway, and these are, first is the steep, significant 500 basis point reduction in corporate income tax. That's, I think, in the legislature, and will be a plus if and when it happens. Second is the lifting of foreign ownership limits, which I think will be embraced by foreign investors in select industries. And the third is the real estate investment trust law being passed, and that's something that we think will revolutionize the real estate sector in the Philippines, and should likewise be good for markets and the economy. So the strategy, and then lastly, well, second to the last, is that we reiterate that this is probably during this period will be a golden opportunity. I mean, for those with a long-term investment horizon, to really buy names, quality names, quality stocks, blue chips at fire sale prices, and thus the strategy is really not to be a hero. I think across the portfolios we have 8 to 10% in cash, but we are selectively improving positions in cheap, best of breed stocks, blue chips, when the market exhibits significant downward moves. And that's what we've been doing. We've been funding that by raising cash from selling non-index issues, which we think we can probably go back to later on. And then lastly, we talked about risk reduction. We have about 8 to 10% in cash for the portfolios. In January, on a final note, we implemented a strategy of reducing non-index names with decelerating earnings growth prospects in our review. Companies like Ayala Land, for example, and reallocating the proceeds into key undervalued index names in favored sectors. And these are the likes of BPI, for example, SM Investments now, and Ayala Corp, PLDT, SM Prime, even below 30. Wow, I mean, fire sale prices. And this current environment merely allows us to follow through with this strategy as blue chips present more compelling risk-return propositions and decent growth. So these are the factors we can control amidst the market panic selling, indiscriminate selling, which we cannot control. So I'll leave it at that. Happy to take your questions later on. Thank you.
Thank you for that, June. Once again, let me remind everyone to please continue asking your questions using the Q&A button on your screens. If you'd like to ask a question anonymously, you may do so by choosing that option in the Q&A section. We'll get to all of them at the end of the discussion. Moving on with the discussion, I'm going to hand it over to Sandra Araullo, who will take a closer look at the situation from a global perspective and show us how ATRAM has positioned its portfolio moving forward.
Good morning, everyone. Thanks for joining us. I would like to take a bit of a step back now, Miguel and June had been very detailed in talking about their own respective asset class coverages. As multi-asset strategies head, I tend to look at the big picture and just try and answer the question of what now and where do I put my money. And in doing so, I want to simplify or want to try to simplify things and understand or give our clients an understanding of what is the situation. The situation is we have a black swan event, and there are two shocks that have driven this. On the demand side, you have the spread of the coronavirus, and it's ongoing. We're in the midst of it. On the other hand, you have supply shock in oil production, where, as Miguel mentioned, there had been talks between OPEC and Russia had fallen through, and as a result, oil had actually dropped 60% in price year to date. So the first order impact here, which we have seen in the past 2 weeks, would be the interplay between these two shocks. So what we're facing now isn't just the pandemic is the very clear market driver at the moment. I guess where a lot of or what gets clients or even asset managers confused is how the second matter of the supply shock in oil is affecting the first problem that we have. And simplistically, it can be treated as a sudden stop to the economy. And that has resulted in asset markets crashing because risks have blown out, and liquidity as well has become an issue. Like we're shut down, we can service clients, but not everybody can. And so that can easily create more panic and more selling. When the local exchange closed for a couple of days, we saw how disruptive it is to the market when it opened, and it really created a lot of dislocation. So that's what we're seeing now. Despite, and as June brushed upon earlier, we've seen aggressive central bank policy action, similar to what we've seen in the global financial crisis. The difference is back then, central banks had a lot of ammunition. Today, they don't. The only central bank that is fairly better positioned would be the Fed and our own. But the other ones, the big ones, ECB, BOJ, they don't have a lot of room. And despite that, they've unleashed what they can. The other thing that markets had been waiting for to kind of perhaps calm the markets are coordinated fiscal responses. And we have seen that, but it hasn't exactly calmed markets down. And this is because there are second order impacts now to the interplay between your supply shock and your demand shock. Specifically on the demand side, on the supply side, the problem is credit now is very vulnerable to dislocation arising from oil price volatility. People who just want to fund obligations might have gone to other exposures, particularly, for example, gold. That's why we've seen gold move in the same direction as other risk assets, when intuitively you would expect it to kind of be negatively correlated. But because of some margin calls and squeezes happening already, we're already seeing this contagion via credit markets, and a lot of them are heavily weighted to oil. It's already seeped into it's going to be a huge headwind further to equity markets. Meanwhile, so what do we expect in the next, call it 3 months even? It's gonna get worse before it gets better. That's the simplest way I can put it. As far as the sudden stop situation to the global economy is concerned, because just looking at the news flow around COVID-19, it hasn't even reached the US shore. Well, it has. There has been infection in the US, but it's still on its way up. It's peaking. There's a pattern to the evolution of how this thing spreads through a population. And from earlier indications, it's weeks. That's why we're all on community quarantine for a month. Some economies have not shut down. Actually, I just heard a little bit of market rumor that the US might close their borders in the next few days, meaning to say air travel is going to be severely restricted to only to civilians are not going to be able to freely move through the border. So as long as the news flow around that is worsening, sentiment is likely to remain really fragile, and you're not going to see any investors, any asset owners jumping in to grab really attractive investments. As June said, it's not the time. It's not the time to be the hero. To be a hero now. So everybody's kind of just waiting for things to calm down. The good news is, if you would go to the next slide, please. The good news is ATRAM on the multi-asset side, and even on the specific equities assets. Even on the specific asset classes within Philippine equity and Philippine fixed income, we had been able to raise a lot of cash even around the end of February, before this meltdown even happened. As Miguel mentioned, there is a bit of blessing in disguise in the form of the Taal eruption, in that we already felt kind of disconcerted on the risk involved there. So we took some equity risk investments off the table and went to cash. And then the whole global situation worsens. And so we just continued on reducing our equity exposure. And I am quite relieved that just before things got really bad, we managed to get to minimum equity exposure, both on the global and the local side. And through all this, it is very confusing. Everything's all over the place. Things move so volatile across all markets. Phil would remind us, as CIO, that there are things that we cannot control and there are things that we can. And what we can control is how we position our portfolios, and how to implement our views and strategies onto the portfolios. And that's what we did. We took risk off the table, and now we have a lot of cash. So just looking ahead, what do we do with that cash? Do we go back into equities? It's so cheap now. We tend to, from an asset allocation basis, we tend to favor Philippine fixed income the most, because as Miguel mentioned, there's a lot of scope for further movement of yields lower. As on the global fixed income side, there is that too, but there's less room. What's more attractive to me on the global fixed income side is the dollar exposure, because right now just dollar cash is king. The other thing that we like, some exposure to gold, actually, because given how central banks have really just gone all the way, it's a race to zero. The next risk that we're looking at, maybe not in the immediate future, but if policymakers don't manage this well, the next risk you're looking at is deflation. And guess what performs the best in that kind of a situation? And even now, it's gold. Even now, with rates so low, except for the some duration exposure, which can balance out some of the risk exposure in a multi-asset portfolio, it's still quite volatile. Fixed income investing isn't isn't risk-free. It's very risky as well. So on the multi-asset side, we're liking to add a bit of commodity exposure through gold because it's not as correlated, or it's even less correlated now in this kind of an environment than it is when things are running smoothly. So that's really it for me. If you have any questions, I'd be happy to answer them.
Okay, thank you, Sandra. Thank you once again to all our speakers. What we're going to do now is open up the floor to a few questions from the audience. Let's start with one for Miguel Liboro, head of fixed income. Miguel, did the BSP fire the rate cuts prematurely?
Thanks for the question. I don't think so. If you'll recall, at the end of 2019, Governor Diokno actually already stated that he was open to cutting the policy rate by an additional 25 to 50 basis points. And that was before the coronavirus really started popping off. That was before the coronavirus really started popping off. That was before the Fed cut by 150 basis points. And that was before we felt that inflation was going to move considerably lower. So he does have the scope to act. And in fact, the speculation in the market at the moment is that the 50 basis points, the sentiment is that maybe he could have afforded to do more yesterday. But that doesn't mean that they won't do additional cuts moving forward, which is in line with our view. So no, I don't think that they fired the rate cut prematurely.
All right, thank you. Another one for our head of equities, Mr. JulianTarrobago Jr. Assuming a U or V-shaped recovery, which sectors will gain most in equities over the next 36 months?
Thank you. Great question. Well, as for sectors, we talked about it earlier. The sectors that will gain the most over the next, well, first of all, we think before sectors, we think the best of breed blue chips will gain the most, because this is a significant, as Sandra mentioned earlier, significant dislocation wherein investors are acting without thinking about valuations, whatever. They just want to get out of the door, regardless of the price. And I can understand that happens during periods of crisis. During periods of crisis, also, at least if you look at the data for the 2008 financial crisis and the early 2000s dot-com bubble or recession, these are the two biggest financial crises over the last 20 years. It was followed by a steep recovery. And that steep recovery, in both cases, especially the worst financial crisis of all time, which was 2008, it was followed by a steep rebound. And normally the first group of stocks to rebound are the blue chips. That said, we think that the best way to position is via still the old names, the industrials. If you're looking at a longer term investment horizon, it's industrials, consumer, banks, and property, and that's how we see it over the long run. More specifically, we are really adding to companies in those sectors that are very high quality, best of breed in terms of management quality, in terms of not just the earnings growth prospects anymore, because people aren't really looking at that. People are looking at the companies that will be here and will become stronger over the next 5, 10, 15 years. And these are SM Prime, for example, Bank of the Philippine Islands, Jollibee, SM Investments, Ayala Corp, PLDT. And we're funding selective buying. We're not, again, being a hero. We're funding selective buying of these issues or these stocks by reducing companies wherein we think the growth prospects over the long term are decelerating, and those that are probably immediately going to be hit more significantly by the current environment. So again, this environment allows us to follow through with the strategy we implemented earlier in the year. As blue chips present even more compelling risk return propositions, it's still decent growth. So yeah.
Okay, great. Thank you, June. Again, we appreciate all the questions from the audience. Please keep them coming. I have a question here for our head of multi-asset, Ms. Sandra Araullo. How about the cash allocation for your feeder funds? Have you maxed it out as allowed by BSP regulation for feeders?
That's a very good question. And to answer it, short answer to that is no. We weren't able to. We did not maximize allowable cash on the feeder funds, and it's really more of a limitation on operations than anything. We're all working from home. We're quite limited in our ability to implement across all of our portfolios. And as a feeder fund, the spirit of a feeder fund, it's meant to. We are not in the best position to really, for lack of a better word, play around with that cash. So the next question would be, what are the target funds doing? And we are actually, past few days have been in coordination with all of these fund managers, and we're finding out what they are doing. It's a mixed bag. Some of them have been able to raise cash ahead. Some were ahead than others, and so we're also part of the task at hand is to kind of do a review of all of these funds, because in this kind of a situation, and as I explained earlier, the second round effects where contagion to credit markets and squeezes, it can really spill over quickly to these funds as well. So one of the things we're looking at is what are the probability that a fund will close. So offhand, there's we've chosen target funds that have really solid AUM base and have been managed for a long time, and even the fund managers themselves have really stable businesses. So in that regard, offhand, I wouldn't say there's any fund that's in immediate risk, but we're still going through the motions of just dotting our I's and crossing our T's.
Okay, thank you, Sandra. Going back up to the top to Miguel, we have a question on FX. The local currency, the Philippine peso, has held up quite well versus the US dollar as compared to the Aussie dollar, the Canadian dollar, etc. Do we expect continued stability in the USD Philippine peso rate?
Okay, thanks for the question. Everybody loves to ask about FX. Okay, so our year-end view, which we gave at the beginning of the year, was that the dollar peso would close 2020 at around the 51.50 to 52 range. As of, I believe 2 days ago, we were actually within that range already, with the spot rate moving up to as high as the 51.80 level before coming back down to where it is today, settling closer to the 51.10 level. Do we expect the peso to continue to outperform? In the short term, I think so. And part of that is really borne out by the fact that the BSP has not really pulled the bazooka out and cut interest rates in line with, at the same rate the Fed has been cutting them. So that is lending the peso some support, because if yesterday, instead of opting to cut just 50 basis points, which is, in my view, more measured response, they opted to just copy the Fed and go 150, then you would have definitely seen the dollar peso blow out past 52, I think. Given everything, where do we see the dollar peso at the end of the year? I think our range still holds, but now risks are tilted a bit more towards the upside, because if this volatility does persist, the dollar's safe haven status will be key, meaning in a risk-off environment, investors will continue to seek the safety of the dollar. As Sandra did say earlier, cash will be king if this environment persists. That said, one of the things against the peso blowing out too much against the dollar is the fact that with the expected deceleration of the government's infrastructure program due to both supply and demand side shocks brought about by the coronavirus, we don't anticipate the stress on the current account deficit to be as pronounced as we had initially thought. And that, we think, from a fundamental basis, will keep it kind of under control. So at the end of the year, we do think that the dollar peso will be perhaps close to the 52 level.
Okay, thank you. Thank you, Miguel. Over to June. What will be the investment strategy for ATRAM Alpha Opportunity Fund, Inc.? The investment strategy that we discussed this morning revolves mostly around index stocks and blue chips. However, Alpha is invested in the second liner companies. Any thoughts on that?
Yes, first of all, thank you. That's a great question. Well, first of all, there's two parts to the strategy. First is in terms of capital preservation, we've raised cash, not by much, to about 10% of the fund, just to, control some of the wild swings potentially from the second liners, which tend to be more volatile. So that's the first part. So the second part of the strategy is really, given what Miguel earlier, potential slowdown in industrial. So given that this fund is more tactical in nature, we've actually reduced positions in industrials, and we're talking about the likes of Megawide, EI, and Eagle, and obviously we've reduced the airlines, which will be hard hit. We've reduced them considerably, and really put on reallocated, at least from a tactical standpoint, into relatively more insulated companies. Seeing the panic buying in the market, for example, impacting companies like Pure Gold and First Gen, which is relatively more insulated, I think, from an earnings downgrade risk standpoint. So from a tactical perspective, we're going into those stocks which we think provide relative short-term safety, and Citibank as well, which is and 7-Eleven, which whose stores are still open. Most stores still open, and also there are stories like we just heard that for Axilum, for example, the sales of Vita Coco have surged. I don't. Well, we need to verify this news article, but it means that sales of coconut water of products of Vita Coco have surged 200% over the recent period, and maybe because of the panic buying as well. So there are areas to seek some shelter from a tactical standpoint, easing up on the infrastructure from a tactical standpoint as well. So that's how we've raised cash to about 10% and reduced the industrials part of the portfolio, added into more insulated consumer names less affected by this, as well as power companies. Given the more tactical nature for this particular fund. And second liner investment universe. Thank you.
Okay, great. Thank you, June. I think we can ask this question to our Chief Investment Officer, Mr. Philip Hagedorn. If now is not the best time to be a hero, what's your advice for people who have sold their positions, who have stayed in the market, or who are not in the market?
That's three different people, I guess, no? I guess if you're not in the market, which is 99% of all Filipinos, that's a fantastic opportunity coming up for you all. I think, to build a portfolio with this, personally, I never thought we'd have a chance to buy stocks at these levels, considering that the country is really, moving forward. We've come a long way, even from the Asian financial crisis, as June pointed out in some of his slides. We're a much stronger country than then. We're an investment grade country with a big foreign reserve levels that can help us through this crisis. We have investments that will come and that are coming. And once this crisis comes through, then I think the economy can get back on track fairly quickly, maybe quicker than many other economies. So there's a fantastic opportunity if you've never been in the market or not in the market today, or maybe had not really dabbled in equities in the past. I think there's a good opportunity coming for you all this year. I wouldn't jump into the market today right away, but for those that are in, I would encourage you to stay in. I don't think it's time to sell at this point. The expectation is for stability in addressing the virus issue in the coming weeks, and that should add stability to markets. If you're averaging down, do you average down at this point? I think anytime you want to enter the market, I wouldn't go all in at one go. I think you have to pick your spots. You have to pick your stocks as well. I think June had a very clear view of what industries may be hurt and may take longer to recover than others. And so if you're going to be picking stocks, I think try to focus on those industries that will be a little bit more stable. And in many of their cases, especially on the utilities, there are dividends actually that will be paid out starting actually next month. So there are some opportunities there. So I think we will recover from this. It may take time. And I think a slow accumulation plan is probably a good plan. But I still caution that the next 2 or 3 weeks could still see quite a bit of volatility. So I would wait a little bit to see a little bit clearer direction, because there's a long way up. So rather than try to guess where the bottom is, it's almost better to not be the front of the herd, kind of in the middle of the pack, and follow the herd as the market starts to recover. That would be my advice.
Okay, thank you, Phil. Miguel, you mentioned that fixed income remains highly risky. Please explain the factors that make it so from the perspective of holders of fixed income assets.
Sorry, might have been the connection was choppy earlier. I just want to clarify that if we're talking about local fixed income, I mean that it is highly attractive from a risk-reward standpoint. So in contrast to that, I actually think that it is among the safer asset classes that you can be invested in right now. I noticed one of the questions was a target for the 10-year, given what we've seen on the 10-year government bond yield, given where BSP action has been recently. So I'd like to tie it into that. Looking back historically, over the last 5 years, the low yield of the Philippine 10-year bond has been at around 3.1%. Now, this happened in 2016. At that same time, the US 10-year Treasury was at its then all-time low of around 1.34%. Today, you have a 10-year US Treasury that rallied on the back of panic to as low as 0.3% just a week and a half ago, and is back at just below the 1.2% level. And you have a 10-year Philippine bond, which in contrast, moved from 4.1 all the way to where we are today at 4.8%. Now, as I mentioned earlier, I feel that the move in local rates was really on the back of just a short-term knee-jerk, sell everything type of reaction. But when you kind of take a look past that, and if you share the same view that given everything, inflation is poised to move lower, that global yields are not likely to shoot up much higher from where they are today, then I certainly think that the 10-year yield, which is currently at around 4.7, 4.8%, has a much higher probability of rallying lower to break 4% and approach those 3.1% levels, given the market environment that we find ourselves in. And that's just from a technical aspect. From a fundamental aspect, as I mentioned, inflation is moving lower. The macroeconomic fundamentals of the country are still doing quite well. And as somebody noted earlier, even our currency has been fairly resilient in this time of extreme market stress on EM currencies. So while we do think that the FX will depreciate, we think it'll be a bit of a gradual kind of move higher, certainly not a spike to 55 or anything like that. And given everything else that we're looking at, we do think that the risk reward for being invested in Philippine fixed income is extremely attractive right now. I hope that clarifies.
Okay, great. Thank you, Miguel. I think we can leave it there for this call. Thank you to all our speakers and for all your questions from the audience. I hope you were able to see the importance and value of long-term investing. That said, I think we should recognize that it has been a difficult time for many of our clients and colleagues. However, I hope today's webinar helped answer some of those questions. If you have any further questions or would like to learn more about ATRAM strategies, please get in touch with your relevant ATRAM relationship manager. Lastly, a recording of this webinar will be released to all of you, as well as posted on all our social media pages shortly. We appreciate you taking the time to join us, and on behalf of ATRAM, I would like to wish you all the best of luck. Please stay safe. Thank you very much and have a great afternoon.